Hey everybody, this is Jose here. Sound check. We are starting in 30 seconds. I would like to confirm that sound is good. I guess it should be, but it would be a good confirmation to have. So quick message on the chat box. Quick hello, everybody, even though some of you are already saying hello. Ray, Ahmad, Paul, how are you, my friends? So we're about to start. 10 seconds to go. Very good. We just reached the starting time for the session. So we are live. We are now in the session. Before we start, I would like to go over a quick introduction. So first of all, welcome everybody. Today is April 26, 2020. In the western part of the world, in my side of the world, which is Asia, it's already April 27. So depending on where you are in the world, welcome to the session. Today we are getting together for sharpening purposes. So looking at our skills, our techniques, our approach to trading. By the way, I forgot to turn on the video stream. How are you, everyone? And based on what I was saying, so today it's about fine-tuning everything that we do. Okay. So before we start, disclaimers. I'll read that quickly so we can start. Disclaimers: the following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And that's the introduction. That's it. So the session is now officially introduced. Here we got a TradeStation on the screen. But beyond all of that, we have a sharpening session in front of us. So we're going to be moving from tool to tool, from TradeStation to TradingView, from questions to answers, all sorts of things to be discussed today. Okay, so let me take a look at the chat box first. Ray, Ahmad, Paul, Ilan, Osman, Roy. Very nice, everybody, seeing you here in the session today. Very nice, to get some time to spend all together. Okay, so a few things. Today is a sharpening session. So I have received multiple questions. One of the questions, it's very relevant and may take me a long time to answer. Okay, I don't know if Marcus is here. Here we go, Marcus. This is your question, my friend. So a very, very powerful, important, relevant question in many, many different ways. So one of the things I want to do today is to discuss Marcus' question because it has so many implications, and I would like to touch on all of this as we start the session today. Okay, so that's going to be one of the items for me to discuss. Another item I want to discuss is a little bit of what's going on with the calendar of activities that we have, so we are in sync. Okay, and then of course, let me bring the browser here. For whatever reason, the browser is not coming into the screen. Here we go. It did now. So I want to look at the calendar of activities and discuss that with you as well. And then, of course, probably the most important part of all is going to be going over other questions that you guys may have. So any moment, anytime, feel free to type on the chat box. Could be questions that are very basic, could be questions that are very advanced. It doesn't matter. Whatever questions you have, go ahead and type it in so I can take a look. I can help you. I can assist you. And if I have any plan to address those questions in a different way in the future, let me be the one to tell you instead of you not asking the question. Okay, so don't be shy. Today is the day to ask questions. Okay, sharpening. Yes, Marcos, of course, and the honor is mine. Your questions are always very thorough and certainly reflect the amounts of time and effort that you put in place. Okay, so certainly, more than happy to begin the session today with your question. Okay, but before I do that, a little bit of looking at the schedule. Okay, so this is April for the month of May. Same structure as you can see on the calendar. So we're gonna have on the Tuesdays. We're going to have short-term trading sessions at 11 a.m. On the Thursdays, same story, 11 a.m., longer-term trading sessions. So with the shorter term, normally we focus on Forex and futures. For the longer term, normally we are dealing with options, okay? And then on the 10 and the 24, we'll be doing some sharpening just like today, okay? So this is the plan for the month of April. Okay, so we are sorry for the month of May. For the month of April, we only got 1 week left, if you wish. Okay, so on Tuesday we'll get together for short term. On Thursday we'll get together for long term as well. Today is the 26th, so we are doing sharpening. Okay, and also notice how we have a forex in action class, which is 5 days, Monday to Friday, 3 hours per day. So this is for the ones of you that you would like to have like a, let's call it a reset, if you wish, and being taught properly, because there is a lot of material, isn't it, in the sharpening playlist in the YouTube channel, isn't it? But if some of you, instead of going through many videos and going back and forth, you want to go through material that teach you how to approach trading in a way that is very structured. So one way to do it is to join that class, and to do that, you would just want to click in any of the pink boxes, and then you will see when next page loads, you have a link here, okay, that gives you access to the product itself on our e-store on the website, so you can then book your seat and be part of the class. Okay, so that's tomorrow, guys. Okay, so if you want to do it, make sure you do it quickly, and if not, either in May or June, we'll run the class again. I'm not sure about the dates as of now, so we'll see. Okay, but just for all of you to know. So this is when it comes to a little bit of planning ahead and being organized. Okay, but let's begin our session today. Let me see. Question, Boyan. How are you, Boyan? A bit of static on the mic. Okay, interesting. 1 second, guys. Let me double check that. That's weird. So is this better? Boyan, could you please confirm that for me? It's strange because this happened some time ago and I was not able to find why, and I didn't change any of the settings, and it was happening today again. So I'd like to know if maybe now it's fine. Okay, so I'll be waiting for the response, and in the meantime I'll be maximizing this Word document. I copied and pasted the key paragraphs on the email from Marcus, and I would like to begin with the question. Better is better now. Wonderful. Okay, is it better like good, or is it just better but you still feel that it's not good enough? Because if that's the case, I can still adjust more. So let me know, guys, because again, it's at least it bothers me very much when I'm listening to something if it's not neat and clear. Okay, so no, not an issue for me to do a bit more adjustment. So anyway, so let's read all of these together, and what I'm going to do is I'm just going to read it from top to bottom. Even though for me to answer these properly, I'm going to have to make pauses, and really, this is not one question. This is many questions, and there are many things here to be addressed, which I believe apply to many of you, and that's why, again, I wanted to start the day with such a great email that is going to be hopefully very useful for Marcus, but many more of you as well, I'm pretty sure. Only a bit when I speak louder. Okay, so let me do a bit more. Okay, what about now? Is it better now? So let me know, Boyan, from 0 to 10. Let me know. Cool. Okay, so let's begin. So again, as I said, first I'm going to read the whole thing so you get the perspective, you get where these questions are coming from. So then when we dive into each of them separately, we can get deeper understanding the context of the question. Okay, so to get a feel if options suit my situation, I like to get an idea about the dollar risk and what I could do in order to get back belief, confidence, consistency, and finally get positive results. I could open a 5 to 10 options account. Therefore, I won't qualify for day trading pattern and will be restricted in option strategies, right? What the minimum dollar per trade that I need to be willing to lose, and how likely would a full stop normally be? In Forex, the dollar risk is adjustable, and in futures, it's about $80 per contract, my experience, for intraday trading and more for swing trades, higher timeframes. in forex and futures, I need to be ready to get a full stop about 60% of the time, my experience. Since the dollar risk may be more in options, I wonder if the likelihood of a full stop is still that high. What option strategy would make more sense to me to learn first? One that is simple and doable with low effort, example, 30-minute day, any time of the day, and is suitable for minimum dollar account and risk. I'm aware that all these questions always depend on the trader himself, the time frames, individual strategy, etc. Okay, good. So again, I'm gonna break this down and go through each of the components one at a time because there is a lot to be discussed here. But basically, as you can see, so Marcus is coming from a great level of experience, a ton of effort put into practice, development of all sorts of things. But as of now, the results are not satisfactory. So the question is, should somehow the big picture question is, should I maybe keep working in the same direction with the same assets that I've been working on, which is forex and futures, or should I maybe turn around, have a 90-degree angle turn and use a totally different asset, which is options in this case, and if so, would that make sense or not, given my capital and everything I know about my current trading style? How would that change if instead of forex and futures that was to be option? So this is kind of like the big picture question if you read all of this. Okay, now it's a 10. Very good. Thank you so much, Boyan. So again, this is a very important question because so first of all, how do we get to this place, right? So how do we begin learning how to trade, begin applying a methodology, and get to a point where we're not happy? Not only we're not happy at the beginning of the message, we can also see getting back belief, confidence, consistency. So in other words, I'm going to use a little bit of a strong word here, if you don't mind. Marcus, feel free to comment. But okay, let's keep it politically correct. Let's just say Marcus is a little bothered by this situation. Okay, I'll just keep it politically correct because it's really frustrating when you put a lot of time and effort and you don't get to the results you want. So then it's really it's a pain, right? Because we are all very passionate about trading. Certainly, when we get into trading, for sure, maybe because we are curious about the markets, we are passionate, as I just said, etc., etc. But also there is a money aspect, and the money aspect to some people out there could be a gambling thing that gives you adrenaline and it's fun, and some people go the route. Okay, but that's normally not the people that put a lot of time of effort. The people that put a lot of time of effort, it's more about money. It's important, money is needed, I want to change something in my life, and not getting to results, then it's problematic. It's frustrating, and then all those words that are not politically correct that I didn't pronounce. Okay, so I stayed in the safe territory, if you wish, but I think that you are with me on this very bad joke of mine, but you get my point, right? So now getting serious. So how do you get to that situation? Okay, so it could be because of many things. Okay, so I'm going to give you a few examples, and Marcus, think about it because that may be you, that may be someone else. So first of all, how do you get to a point where you are learning, you acquire all this incredible amount of knowledge, but then you don't get to where you want to be? Okay, so the classical cases that I have seen, okay, and I'm not saying this is your case, Marcus, or any other of you, but I've seen it enough to kind of standardize it and be able to call it a classical mistake or a typical mistake among traders. So a classical mistake is, number one, to spend too much time trying to look for a methodology that is always better than the prior methodology. Okay, so have a massive hunger for perfectionism where no methodology seems to be good enough. Okay, that's one part of the problem. Okay, which again could be your problem, Marcos. I would say not, because we've discussed some of those things before. So I would say not in your case, but it certainly is the problem of many. So let's say you buy a book, you learn a strategy, you apply it, it gives some results, whatever it is. But then while you were applying it and you were maybe practicing it, you are reading a second book, and the second book gives you ideas. And as you get those other ideas, you're like, wait a minute, if I was to apply some of those ideas to the strategy I learned from the prior book, that would make the prior strategy a better strategy. And now you start tweaking that prior strategy, trying to make it better than the author of the book. And in the middle of the backtesting period or the testing period of that strategy, you start creating variations, and you start getting into a territory where now you are testing on top of testing, measuring on top of measuring. And then in the meantime, you're reading book number 3 or attending a class somewhere online, or watching 5 more videos on YouTube, or watching me here on the Trail with UFO channel. And now you get a few more ideas, and now you start mixing that again, and you get into that circle or that spiral where basically you develop multiple methodologies, multiple variations of methodologies, and they all either make some money or break even, or don't make money, but you find a way to fix it. But then it's not amazing, because it's like sometimes you get 5 losses in a row, and then it really mess up your month. And then if you keep trading, then the next month would be fine. But because you just got 5 losses in a row, and you're still, processing or trying other methodologies, so next thing you know, you lose the interest on this methodology after being unprofitable for a month, and then you go into another methodology, and you never realize what would have happened to that other methodology if you had kept trading. Maybe it was a great one. It's just that it was a tough month in the markets. Okay, so again, excess. I'm just going to summarize the whole thing by saying excess of perfectionism could be a problem. And make sure you understand, this is coming from someone who is a perfectionist. Okay, I am a perfectionist, and one of the things I had to learn to be a better trader is to tune it down. And by the way, when I felt the benefit of tuning it down in trading, I actually tune it down in other aspects of my life too. And to be honest, life is a bit easier. So I kind of developed myself more into, instead of a perfectionist person, I evolved myself more into a pragmatic type of person. Pragmatic, one definition of pragmatic means that you use 20% of the effort in order to get 80% of the result. Being happy with 80% of the result, knowing that in order to get 100% of the result, you will need to apply 100% of the effort, where here I will get 80% of the result by only applying 20% of the effort. Okay, so I welcome that. Okay, and again, this has a lot to do with personalities. Maybe it has to do with genes. Maybe it has to do with the people that you saw around you when you were growing, including parents, brothers, sisters, classmates, and maybe we get inspired by other people, and that basically makes up our personalities. Okay, so in my case, I had to evolve and move away from that very perfectionist approach to trading, which also had some benefits in the beginning, but at some point I had to divert, okay, and be happy with being a bit more relaxed. So I actually trade, and I actually embrace when maybe a week is a losing week. It's okay, because I know what to expect from a methodology if I keep applying it, instead of I get discouraged and then I stop. Okay, so this is again something that may apply to some of you. And by the way, feel free to comment. Okay, this is an open conversation. Feel free to comment. Maybe some of you have been there. Some of you have overcome that situation doing something else which was different than me, or something that I never thought about. So being here in a group, it's okay. It's certainly what we should do, is to enrich each other. Okay, certainly I am your guide, if you wish, and therefore I'm the one with the microphone here. So I'm the one supposed to to do the talking, if you wish. But certainly we have the chat box, and many of you have great level of experiences. Okay, and feel free to share. Okay, I'm not here to kind of like be the only one who says how things should be. Okay, because trading is a very open type of subject. Okay, it's not like mathematics. Okay, it's more like, to me, I think more of trading like medicine. Okay, so you may have Western style of medicine. You may have more traditional Chinese style of medicine, and you could be a believer. Some things may work better for one thing, some things may work better for another thing. In other words, there is not an absolute. It's not like mathematics, if you wish, right? So feel free to comment, and we all enrich each other. Okay, Ray, yes, I can relate. Mark, sounds like me. Onga, the best strategy is learning UFO. Is this right, Jose? Well, it works for me, Onga, but I have to say there are other ways on how to trade. Okay, UFO is my way, and I know it's helping many of you, but at the same time, it doesn't mean it's the only way. Okay, so the markets are made of millions and millions and millions of people. Okay, so as long as you use a proper technique that gives you odds, that the technique makes you mechanical, so you act consistently, so that consistent action produces consistent results, and then you manage your emotions, so you can actually apply all of these with consistency. Then you should be fine. That as a quick summary of what trading is all about. Certainly UFOs work for me. It's my little baby. What can I say? Isn't it? Paul, sounds like this month for me down around 500 pips when March was up over 1,000 pips. Yes, Jose, I can relate. Okay, got it. And by the way, I appreciate your comments as well, because again, another aspect of learning and growing is being humble. Okay, and this is a learning environment. We are doing this in open in the YouTube channel, but this is between us. It's a learning environment, and we are here to learn. And one of the important things to learn is to put egos on the side and all understand, including myself, the market is bigger than us. There is always something to learn. And probably this is the beauty of trading. It's like a sport. You can always get better. Is that making sense? So appreciate it, all your comments there. And Paul, certainly, again, we need to look into specific trades and specific actions that you had in the marketplace. But certainly, the markets, since, let's say, the beginning of the year, especially since February, March, the markets are not a joke. Okay, the markets are not a joke. I have never seen the markets in the current condition ever in my life before. Okay, and I've been trading since 2008, so it's not like I've been trading since the 70s. But it seems that nothing has been equal to current market conditions but 1987. So probably very, very few people have seen the current market conditions, and probably they were not even the same, because in 1987 computers were not relevant in the marketplace the way they are now. So crazy things are happening in the marketplace, and these hurt results at times. This also provides unique opportunities. Okay, so we need to look at both sides, because there is always both sides. But also the problem is that precisely because there are two sides, this creates a lot of problem in the beliefs. Therefore, hurts the confidence. Because probably, Paul, if you had negative results this month, like Marcus says at the beginning of his email, maybe your confidence is a bit hurt, and then the way you're gonna trade next month, you may even go ahead and say to yourself, you know what, I'm gonna trade, but I'm gonna go with half of the size. And I'm not gonna say that would be a wrong approach, but at the same time, what if next month is an amazing month, and then you go with half of the size, and then you only did half of the profits, right? So again, there is always the two sides of the equation. And that's one of the reasons why trading is really challenging for many people. Trading is not an easy thing to be done. And that's why it's important that, we get together, we support each other, we keep each other accountable, we open up to the problems we have, we are ready to accept, whatever is it that's going on, and keep growing, So just to share a few experiences, for example, in the middle of March, there was this one day where I'm looking at the futures markets, and the futures markets were halted multiple times already that day. They were halted at 5% down. And then I'm looking at the SPY ETF, and the SPY ETF in the pre-market session was not halted. It was 11% down. So if you think about it, that's free money. That's an arbitrage opportunity. You buy the S&P ETF, you short the futures, and the SPY needs to go up or go down, but the futures needs to catch up whatever the SPY is doing. And because the SPY was 11% down and futures only 5%, so they should catch up at some point. So shorting the futures and buying the SPY was free money all the way. Now, I never seen such an arbitrage opportunity. Never. Okay, never. So this market condition, it's way more unprecedented even though unprecedented is already an absolute term, but it's okay. So this situation is crazier than 2008. So what did I do when I saw such a crazy piece of information? I was lacking confidence. In one hand, I'm tempted to take this trade with a massive position because it's free money. But in the other hand, it's like, this is too good to be true. So what did I do? Started looking at more information. And what did I see? I look at the VIX, right? And what did I see with the VIX? The VIX was down by 25%. So how can that be possible? When the markets go down, the VIX tends to go up. And certainly if the market is going down 11% overnight, the VIX for sure has to be up. For sure. But instead, it was down by 25%. So what did I think at that moment in time? I thought, that's an anomaly. Something is wrong with the mathematical process that calculates the VIX and plots it in the chart. Something is wrong with market data. Something is wrong with the TradeStation charts. Something is wrong somewhere. And what happens? I didn't take the trade. And then I was absolutely right with, it was just crazy. It was just unprecedented, but it was free money. And I missed it. So then after that, you take a trade and then you get stopped out. Now, how do you feel now? So you saw an unprecedented situation. You saw data that seemed to be inaccurate because it didn't make sense based on common sense. Then you take a trade, you get stopped out. So what happens to your confidence, right? So trading is challenging because of all of those things, okay? So and more. So we certainly need to be very, very well aware of our methodologies. And one of the problems is to spend lots of time doing lots of testing of so many different methodologies and variations and so on, always looking for improvements. Well, that puts you in a position where not only it's endless and you never finish that process, and that may get you in a position where you've been back testing for a year, but you never traded with real capital. On top of that, when something like that happens, then what would you do? Well, if you were to be scientific in your approach, you should now discard your methodology, because given the fact that the market conditions are unprecedented, so you should not trade it unless you get samples enough that justify trading. Is that making sense? Where if you were to assume that there will be wiggle room for variations, okay, and that in the end this is a probability game, and as long as you manage risk and you have some edge, some probabilities on your side, and you manage your emotions and you keep going, being very, very perfectly and professionally disciplined, so then you'll be fine, okay? But that beyond confidence is more of acceptance, okay, which is a word I don't use often in the sessions, but it's also acceptance, okay? So you need to accept that the confidence we need to trade needs to be solid, but at the same time, the level of confidence that we need to trade should not be in line, okay, with the quality of the results you get from your trading methodologies. Because if the only way for you to call yourself a confident trader is that your methodology profits 90% of the times, well, basically, then trading is a utopia, because that is not going to happen. Or if it's going to happen because you found a very good, amazing methodology, or you just found a way to fine tuning, which is really, really amazing. Well, the problem, and the reason why I'm very strong when I say it's not going to happen, is because then market conditions will change to anything else. And then what happens the day when 90% becomes 60%, where you may still be making money, but you just lost your confidence. So now what? Okay, so it's important to be acceptant of the fact that the market is almost a random place, or some statistician would say it's a random place. And therefore, probabilities are to be played instead of, having this super extra over perfectionist approach to trading that gets you into that spiral, which is basically a very poisonous type of spiral that gets you into frustration, lack of confidence, never trading, never making money. And then, then you apply Murphy's Law to that, and it's awful, because then finally there is one day where you're like, okay, I'm going to call this good enough. Let's begin. And guess what? The moment you begin, Murphy's Law applies and your first 3 trades are losses. The next thing you know, you give up, right? So we cannot be in that position, okay? And that's one very big mistake that happens. And spend many minutes to discuss this because it's a mistake I've seen often enough to discuss. Okay, so again, I am 100% not saying, Marcus, even though you are the one who phrased the question, I'm 100% not saying that's their case. But certainly it could be the case of many. And I wanted to take advantage of your question to illustrate this point. And I want to discuss other scenarios as well. Okay. Let me see questions. Onga, yes, when I know use AutoUFOs, I have to any change of my trading plan and I feel more comfortable on my setup. I know this day. Well, I have made a few mistakes that I am aware of, but I am continuing as normal. Good, perfect, Paul. Onga, Jose, do you have any group conversations? I mean, for shared experience of some discussion. Well, Boyan, maybe yes, perfect. You just read my mind with the Discord group. Yeah, it'd be great if you could share that on the chat box, Boyan. Thanks for that. Ray, I agree. Right now, my confidence is being affected after my 3 months evaluation, but I would rather backtest than look for another strategy because I might end up being confused. Yeah. Yes, Onga. Oh, sorry, Wayan. That's a new for me. I will try to download it after that. I will try. Yeah, wonderful, perfect, wonderful. Okay, so another reason why sometimes we get, or I've seen people get to a place where it's problematic, is because when looking at a methodology, the trader is only looking at sample, 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 sample. Let's see what happens with it. Let's see what happens with it. Let's see what happens. Well, we just concluded, on Friday, a backtesting course with Becky. I'm sure some of you were part of it. And one of the things that we said in that course is that when you backtest, you should backtest the methodology the way you would trade it. And this has many implications. For example, the time of the day at which you trade. Okay? Because some traders may collect samples of a methodology, as many as possible, assuming that probabilities are probabilities. And if instead of backtesting a methodology, let's say you can trade from 10 to 12. So instead of backtesting your methodology from 10 to 12, you're going to backtest the methodology 24 hours a day. And instead of 45 samples, you're going to get 750 samples. Some traders are going to say that that's better from a statistical point of view. And the answer is yes and no. Because from a statistical point of view, for sure, mathematically speaking, yes, is better. But at the same time, you are also missing the fact that markets may not react to your methodology the same way at different times. But also, and most importantly, you are also missing the fact that the trader applying a certain methodology at 4 a.m. will not react the same way to the trades and the setups and the trade management rules and the confidence and everything else. So I'm talking about trading psychology. It's not going to be the same at 4 a.m. compared to at 10 a.m. It's not going to be the same. So if you backtest like 750 trades and no matter what time, yes, you do get a good statistical measurement of whatever it is that you measure, but assuming you are a robot. And we are not. Okay, we are not. Even if we have many tools, and going back to Onga with AutoUFOs and many other tools, we have a lot of processes that forces us to be mechanical. But still there are times that unconsciously, and the problem is that when this happens, not this is the word I used, it's happening on the subconscious mind. There are times where we decide to take a trade or we don't, and we don't realize why we did or we didn't. And this has a lot to do with inner beliefs that are beyond my understanding of human psychology, and therefore I could not explain that better. Okay, but the fact is that we are human, we are not robots, and therefore when building your confidence and backtesting and then practicing a methodology with paper money or small capital, it is important that you make it as equal as possible as the real conditions, instead of just building that amazing, multi-tab, multi-row spreadsheet that in the end is great in the theory world, but then it does not represent what would happen to you as a trader. Okay, so again, it's important you do that in this way and get to a proper conclusion. And if you do it in this way, normally you should get to a good place. And certainly it's going to take time, okay, because learning how to trade implies time and effort. There is no magic formula, magic miracle, but at the same time, you should get to a good place if you follow such process and you are relaxed and realistic with the expectations of what you attempt to do with trading. Okay, because that's another reason why some traders are not satisfied with their methodologies, which is you may have a $5,000 account, and the reason why you trade is because you really dislike your job, and what you want to do is quit your job and trade as a living, and maybe $5,000 in an account is not enough. I mean, that for sure would depend on countries and currencies and cost of livings and many other things. But as a rule of thumb, I would say it's certainly not enough. Okay, so we should be realistic. We should keep in mind things such as, what would let's say a hedge fund manager is looking for traders, and they hire headhunters to look for traders to hire them to trade for the hedge fund. So those headhunters probably would ask for your trade statements. And as long as you were to be able to prove 5% consistent results per month, you would have a job. Okay. So 5% a month, that's 60% a year. That would be seen as amazing by hedge funds. So what's the problem in the world of retail traders? Most retail traders, okay, may try to make 60% per month instead of 60% per year. So what's the only way to do that? Well, is to find those methodologies which are super active, or methodologies that work very well only during certain market conditions. So the problem is that you apply those methodologies during those market conditions, it's amazing. Then the market conditions change, and then it's a disaster, and then you give up, hurt your confidence, etc., etc. Okay, so again, be realistic with what can be made in the markets. Be realistic with the size of your account, with your results. All of those things are critical. Okay. Now, let's say you have done all of this, and you get to a point where it's like, you know what, futures and forex is not working for me, or I got tired, or whatever, and this could happen, by the way, because we are human. Okay, we are human, and this could happen. It's like, I don't know how to say it. It's like some people prefer to drive a car and use a manual transmission. Some people prefer to drive a car and there's no way they would use manual transmission. They use automatic transmission and that's it. And it's really, really no way they're gonna bother to drive manual transmission. And if they have to, they will just give up, right? So sometimes in life we have preferences that may come for whatever reason, and those preferences become very strong beliefs, and that's how we live our life. Okay, I know a person, I remember that, and this may sound funny, but it's a real case. So this person was driving a car with manual transmission, stopped in a red light, left the car with the first gear in, was holding the clutch. Okay, so and the brake, of course, and so the car is not moving, but there was one gear that was inserted, the first gear. So probably waiting for the red light to become green and then accelerate. But the fact is that a bad driver was coming from behind, hit this car that was stopped in the red light from behind. So of course the car moved. The driver got scared, so released the steering wheel, released the pedals, and because there was a gear, in the first gear position, so the car, before the engine fully stalled, the car moved further forward and hit a biker that was on the side of the road. And when the insurance company claimed, so basically they were making this driver guilty because, and they attributed the problem to, if she had left the car with the neutral gear instead of the first gear, then the insurance company of the other driver would have had to pay the biker. But in this case, it was the insurance of the other driver, the ones that left the first gear in, right? So what was the outcome of that situation? So this, okay, sorry guys, something just happened on my screen. Could you guys please confirm? I'm really don't know what just happened. Everything went blank, but now everything seems back to normal. Could you guys please confirm that the screen is correct? I think it should be fine, right? Yeah, I think so. So yeah, something weird just happened. Everything went blank on my end, and then everything back to normal. So anyway, so my point is that this particular driver developed a very strong belief, which is no way I'm driving manual transmission any longer in the rest of my life. I will always drive automatic transmission. That's it, right? So you may have concluded, hey, look, I've been practicing Forex and futures, and yes, maybe I could have done a better job, or maybe not, or maybe whatever. But you know what? I'm done with this. In order for me to restart and get to a better place, I need to do it with CFDs, I need to do it with options, I need to do it with cryptocurrencies. I just need a fresh start. I need fresh air. So if that's the case, it's fine. Okay. And with that assumption, okay, I'm going to go ahead now and talk about options, which is the second part of the question with Marcus. What a long answer, isn't it, Marcus? But again, pretty important stuff for all of us to think about. Okay. So now let's talk about options. Okay. So first part of this options question has to do with I could open an account with 5 to 10K. So let's talk about requirements to trade options. Okay. So requirements to trade options. Well, it depends. Okay. If you look at brokers, most brokers would allow you to open an options account with $2,000. Most brokers. So the answer to your question, Marcus, is yes. With 5 to 10,000, you could certainly trade options. Okay. But if you are dealing with options on stocks, okay, options on stocks, which are, I'm going to have on the same category ETFs. Okay. So that is an equity product. And I'm referring as well to the US market because it could be options on stocks in India. It could be options on stocks in China. So it doesn't need to be US, but options in the US market are the most liquid in the world. So I will assume this is the market you are referring to. So, well, if you are using derivatives linked to a specific product, okay, so then whatever limitations or requirements that product have will impact your derivative contracts. And in this case, as you mentioned yourself, I am referring to the pattern day trading rule. Okay. So there is a rule in trading stocks, not options, stocks, which is called the pattern day trading rule that states, okay, so let's see if I can say this correctly, that if your account is greater than or equal to 25K, then you have no limitations. You can take as many trades as you want whenever you want, including intraday. So in other words, if you want to trade stocks 250 times a day, the same stock, you can go ahead and do it. You can have 250 trades in one day, which would be absolutely crazy. But if you want, brokers will be happy to take those trades. Okay. Now, what if your account is under that? Well, if your account is under 25K, okay, so then your account would not be qualified as a PDT account. Okay. And therefore, even though it could be a margin account, okay, even though it could be a margin account, the problem is that now you are restricted by the pattern day trading rules, okay? And if I am not mistaken, this would allow you maximum to have four in and out trades in 5 business days. I'll type it as trading days. Okay, 5 trading days. So in and out trades means, okay, in and out trades means you buy now, you sell next. That counts as one intraday trade. Okay, if you sell short now and then you buy to cover next, that also counts as an intraday trade. Okay, so buy and sell or sell short and buy to cover, that's an intraday trade, and the second part too. So if you had taken both, so this would count as trade number 1, this would count as trade number 2, okay? And if you do another one and another one, and you do that in less than 5 trading days, okay? So you do a couple of trades on Monday, a couple of trades on Tuesday, right? That's less than 5 trading days. So what happens when you reach to Wednesday? Okay, or actually even on Tuesday itself, after you complete the second trade of the second day, which is trade number 4. So what would happen to your account? Then your account is frozen and you cannot trade until 5 business days later. Okay, where the trades from the first day is kind of like a rotating 5-day cycle, if you wish, where the initial 2 trades would now don't count any longer because you have already surpassed 5 days since you took those initial trades from the Monday. Okay, so buy and sell from the Monday, and sell short and buy to cover from the Monday, right? Those initial 2 trades, and then you would be allowed now to take 2 trades, but no more than 2 trades, only 2, because the trades from Tuesday are still counting, and in that rotating cycle of 5 days, you still got trades that are counting. Okay, so you will have that problem. Okay, now what is not a problem, and you will see why I'm explaining all of this, because it has a lot to do with options. So if you were to do buy or you were to do sell today, but you don't close the trade, so you leave it open. Okay, and by the way, I'm just realizing I made a mistake here. It's not 4, it's 3. Okay, it's not 4, it's 3. Sorry for that, guys. I meant to say when you get to trade number 4. Okay, so it's not 4, it's 3. Okay, so if you were to buy and you don't sell today, or you were to sell short and you don't cover today, in other words, you leave the trade open overnight, so then it will not count as an intraday trade, and therefore next day you can take another trade, or 2 or 3, not 4, up to 3, and leave them open. So you could take 3 trades today, and 3 trades tomorrow, and 3 more trades the next day, and 3 more trades the next day. And as long as you don't close them, you can have a portfolio with 20 trades, okay, where it took a few days for you to enter 3 trades at a time. Okay, and that's the most you could do if your account is under 125k. That's the most you could do. Okay, so how does that apply to options? Okay, going back to what if your account is 5 to 10k? Well, this applies to options because in options trading, it's either you trade single strategies, okay, single strategies, or the way it's technically known in the industry is simple strategies. Okay, simple strategies means they use one options contract at a time. Okay, that's what a simple strategy is. So you buy a call, or you sell a call, or you buy a put, or you sell a put. That's a simple strategy. Okay, but then you also have complex strategies. Okay, which is more than one options contract at the time. Okay, and within more than one options contract at a time, you have, I'm gonna use a very specific term because it's super relevant, because it may be your bread and butter. You have option spreads, okay, which normally there are 2 units at a time. Normally, not always, because if you do a ratio spread, for example, or you do a back spread, so then it's 3 units. Normally it's 2, okay? Or you can also have the very complex spreads, okay, which normally, you can certainly call them spreads, but normally people would not call them spreads. They would just call them their name, such as iron condors, iron butterflies or butterflies, and all of these, normally you would use a name, and those are 3 or 4 units each time. Okay, and what's the problem of that? Well, up to 3 I'm fine, but when you get to 4, so what's the problem? For example, let's say you want to do an iron condor, where you buy a call, you sell a call above, and then you sell a put and you buy a put below. How many units is that? Okay, well, the iron condor is made of 4 units. Okay, the iron condor is made of 4 units. So in other words, if your account is under 25k and you place an iron condor order, what's going to happen? Okay, you get a rejected order message. That's what's going to happen. It's going to be order invalid or not permitted or not allowed, or depending on your broker, you're going to have a different message, but you will get your order rejected because being under 25K, the concern of the broker is, what if you sell the Iron Condor, which is 4 units, and then you change your mind and you close them, right? You could not close them because the PDT rule does not allow you to execute trade number 4. And in this case, you will be executing trade number 4. So the broker will then stop you. Okay. So how can you deal with this? Okay. What could be a workaround? Okay. And basically, I'm taking you back to when I started learning how to trade myself, which I started with limited capital. Okay. So my first options account was under 25K. So if I wanted to do a condor, which is buy the call, sell the put, buy the put. So how would I do that? Okay. Well, I would have to break it down into 2 pieces. And in one day, right before the close, I would buy the call and buy the put. Okay. And this, by the way, has a name in the industry. It's called a long strangle. Okay. So I would do the long strangle on the first day. Okay. And next day, I would then do the short strangle. What is the short strangle? The short strangle is the 2 units in between. Okay. I would start with the long strangle because if I did the short strangle, then I got unlimited risk. Also, it would tie up much more margin. So then I would start with the long strangle that uses limited margin and has a limited risk by definition. So then the next day when the market would open, right at the open, I would do the short strangle, and now magic, I got an Iron Condor in my account. But it would take 2 days for me to enter. And if you had a gap on that stock overnight, then you had a problem because your strangle may be giving you a problem. And now the credit you will collect for the short strangle is probably much less. And that was problematic. And this happened to me a few times. And it's certainly not ideal. Therefore, if you were to start your account with limited capital, maybe one of your rules is, you know what, I'm just not going to do that. Maybe one of your rules is going to be, hey, I'm just going to pass and I'm just going to focus on the spreads, which are 2 units at a time. Okay. And instead of using time frames like what you suggested, 30 minutes, okay, move it up. Okay. Move it up. So you do all your trades to be to last more than 1 day. So you never get to expose yourself to the PDT rule, because if you do a spread, okay, a spread could be done by, selling a call and buying a call, for example. That's called a bull call spread. So if you did a bull call spread, for example, and you hold it into tomorrow, none of these 2 trades, because technically that's 2 trades, none of these 2 trades would count against the PDT rule. So then the next day you can open another spread, and the next day another spread. So basically you would be limited to 1 trade a day, because each trade is 2 units, right? If you do spreads. But the beauty is that now you would keep adding trades every day. And in the end, it could shine. It could be okay. It's not going to be too bad. Okay. Of course, like all businesses, the more money we have, the more money our businesses do. Is that making sense? So if you have much more capital in the account, then you have no limitations. And on top of that, you have larger size, you can be more diversified, and it's better. But if that's going to be your starting point, believe me, I understand where you're at, Marcus. I just told you where I started myself. So you could certainly do that, okay? Now, I have more to discuss here. Let me take a look at questions. Very good. Very good. Okay, everybody. Perfect. I see there are not many more comments, so I guess everybody's okay. So I'm going to take a sip of water and I'm going to keep going, okay? And again, and depending on your questions, so if you have questions about anything, guys, even though it's not related to what I'm doing right now, please go ahead and type it on the chat box, because if I see that you guys have many questions, then what I'll do is in a minute, I'll give you a break and then we continue. And if there are not many questions, then I'll continue until the end and then we're done. Okay, so I'll leave it to you to time the duration of the session depending on if you have questions or not. And if you don't have, it's okay. But if you have, this is the time. Okay, everybody? So 1 second. Thank you so much. Good. Okay, so let's keep going. So we talked about the size of the account and day trading. Okay, now what is the minimum per trade? Okay, so the minimum per trade varies greatly. okay, varies really, really greatly. Okay, so if I move into TradeStation, okay, and I look at a stock like Tiffany's, okay, which is trading at $126 per share, okay, so if I load the option chain, okay, so loading Option Station Pro, and I see you guys are typing a few questions. Wonderful, guys. Come on, come on. I've seen TradeStation do better than this. Okay, something is going on here. It's taking a little bit of time. Oh, it's here. It's loading. Okay, got it. Here we go. So if I look at Tiffany's, okay, and I look at the option chain, TIF, and we load the option chain, and I'm just gonna pick. Okay, I'm looking at May 15th, so let's use that one. So if you look at the options on Tiffany's, and well, actually that one is really not liquid. Let me go ahead and June 19. Okay, that's way better. So we got 2.3 and 2.4 if you were to buy the 130 call. So in other words, the cost, okay, I'm just gonna do very simplistic math here, okay? So for a stock which is worth $130 per share, the cost would be 240. So 240 divided $130 per share times 100 shares per contract, that's $13,000, okay? So you can control that stock using $240 instead of 13,000, okay? So that is, okay, basically you need 1.8% of the cost of the stock to be in the trade, okay? So that's what we get with Tiffany's, okay? Now, if I move into another stock, okay, and you will see, well, look for an extreme case, okay, BHC, for example. So BHC is currently trading at 16.36, okay? So 16.92 right now here on the chart. So 16.92, let's look at BHC, and I'll look at the same expiration, June 19. Okay, so June 19. So what do we have? The price of the options is 185. So if you look at 185 is the amount of money I need to pay for the options, given the fact that the stock has a price of 17 times 100 shares. So I add a couple of digits, isn't it? So 185 divided by 1,700 times 100 is 10%. So in other words, in the case of Tiffany's, I only need 1.8% of the cost of the stock to be in an options trade until June. In the case of BHC, I need 10% of the cost of the stock to be in an options trade, which is equivalent, which is a call. I mean, if we were to not to be trained in options trading and we were to use the same vocabulary and terms that people that don't trade would use, probably someone would say, "Oh my God, the options on BHC are very expensive." Okay, they are 10 times more expensive, or almost 10 times more expensive than the options on Tiffany's, because you only need 1.8%, where here you need 10.8%, right? Well, actually, 1.8 is almost 2, 10 is 10, so it's like 5 times more expensive, okay, rounding numbers. So certainly, and that would be a good observation, okay? But now, of course, in options trading is way more complex than that, because there is options pricing models, there is what we call implied volatility. So what if that stock, BHC, is expected to move at a rate of 80% a year, where Tiffany's is expected to be the most boring stock of the whole US market and is expected to move 1% a year? Yeah, so sure, you pay 1.8% for an option, but the most the stock will move is 1%. So you are basically guaranteed you're going to lose money on that one. Is that making sense? So that would make that option to be very expensive from an options pricing point of view. Okay? But ignoring everything I said, because of course, what I'm about to say now is oversimplified, unless I say what I just said, okay? Because of course, options trading is a very, very special thing, okay? And we have, I believe, 7 recordings on the Sharpening playlist, okay, that you could go over that talk about options pricing, okay? But long story short, as a rule of thumb, normally the lower the price of the stock, or the more boring the stock, the cheaper the options. Where the most expensive the stock and the most volatile the stock is, the more expensive the options. So if you look at a stock like AT&T, for example. Okay, so I'm going to look at AT&T. I almost never trade AT&T because it's quite cheap. Okay, 29, and it doesn't move too much. Okay, so 29, that makes the options to be 140. So you will need $140 in your account to trade AT&T. If instead of AT&T you were to trade, let's say, Amazon is much higher price point. It's a way higher price point, but also not only higher price point, it's also more volatile. It really moves. So let's take a look at the updated price of Amazon. It's $2,400. Okay, so of course, then the prices of the options is 154 times 100. Okay, how much is that? Well, that's going to be $1,500 for you to be in the trade. Does that make sense? So you need way more money for you to in the trade with Amazon than AT&T. Why? Because the price of the stock is more expensive. So the more expensive the stock, the more expensive the option. But also, the more volatile the stock, the more expensive the option. So, having said all of this, coming back to your question, so what is the minimum dollar per trade you need? Well, it depends on the amount of money you have and the risk that you want to assume. Knowing that the more expensive the stocks, the more expensive the options. So you will need to define a few things to decide which options to trade. For example, let's say you tell me, Jose, I want to trade a methodology with options where I am directional only and I'm going to run maximum 3 trades at a time. And I have an account of 10,000 and I want to risk 1% per trade, which is $100, right, per trade. And I want to risk maximum 3% of my account at any time. So if every trade risks 1%, which is 100, and you want to run 3 trades in parallel, 3 times 1%, that's 3%, which that means your rules properly. So in other words, you need at each moment in time, you need to get into options contracts, which are $100 maximum per contract. So you can run 1 contract each 3 times to meet your risk management rules. So beyond how much capital you got in your account, you need to think about the risk that you want to assume and your trading methodology and your philosophy on how many trades you want to run at the same time and things like that to decide which stocks to trade. And that may limit you, okay? And like, for example, here, when we are running the scanner, right, and I'm looking at particular directional trades, okay? So in my scanner, I'm not setting myself a limit. So when you look at my parameters, okay, when you look at my parameters here, one sec, right here. So when you look at my parameters, you see that I am only requiring the price of the stock to be $15 or more. Okay. Now, of course, Amazon was 2,000 over. So what could you do in your case? Well, in your case, instead of greater than, you may end up using between. Okay. And you say, hey, between 15 and 50. Sorry, 15 and 50. Maybe that's going to be your rule, because out of experience, and this will need to come from experience, so you will need to practice this and see what the results are. So, so from 15 to 50, you may find a great amount of trades where the price per contract is low enough so you can execute easily given the size of your account. Okay, so you will need to basically define your methodology, then go ahead and keep running the scanner for a week, 2 weeks, 1 month, 2 months, and basically conclude that, hey, you know what? In order for me to save time, most of the times I run the scanner between 15 to 50 or 15 to 35 or 15 to 80. I get trades that match the account size and my risk management parameters, and that's how I'm going to trade. Okay, so this is for you to experience with, because again, that would be very particular and specific of traders. Okay, but I'm not done with this because there is more. Now, going back to what we had. So I'm going to go back to AT&T. Okay, so back to AT&T. Let's say you buy the 30 call. That would imply you paying $140 per share. Okay. Now you have two ways to deal with this. Okay. I'm going to right click, analyze and buy a single call. And I'm going to go back to right click, analyze and buy. And I'm going to do a vertical spread. Okay. Now, of course, explaining how to build a spread exceeds the question and the amount of time we have. And we have sessions already where we did that before. So I will just make up a spread very quickly so I can talk about it. Okay, so give me 1 second, guys. Just give me 1 sec. So I'll adjust something on the screen that makes sense. I'm just looking for something that makes sense enough. One second. Hey, I went too far. Okay. Something like that. Okay. And now 1 second. So that way I can be very, very specific with the example and you get my point. Well, yeah. Let's see, 32. Okay, something like that. Good. Okay, so let's compare. So what do I have here? Okay, so on the top, and by the way, notice I have unchecked everything. Okay, so everything is zeroed out at the moment. Okay, so I'm gonna work on that in a second. But first, on the top, I got a single call option. So where I am buying the 32 call. Where in the bottom part, I got a vertical spread. Okay, where I am buying the 31 call and selling the 35. Okay, buying the 31, selling the 35. Okay, so just to be visual, very quick. So I am comparing buy the 32 call on the left versus buy and sell. So sell the 35 call and buy the 31 call. Okay, so now this on the right is a bull call spread. On the left is a single call option. So again, I can spend hours talking about this. But for now, let's say those two trades are going to be equivalent, okay? Because, let me do one at a time. When I look at the vertical spread, it has a delta of 30. I'm looking at the current price, okay? So let's pretend you're taking the trade now. So it has a delta of 30, okay? Around 30. And if I look at the single call, okay, it also has a delta of around 28. Out of simplicity, you know what, let's make it 31. It's going to be a bit, yeah, it's, you know, it's, the thing is that it's too much, it's 38. So I'll leave it as 32, okay? So 32, it's 28. Let's pretend it's 30, okay? So in other words, let's pretend buying the 32 call, it's exactly equivalent to buying the 31. Selling the 35 is not exactly equivalent, but delta-wise, let's pretend it is, okay? Well, what are the implications? Well, the implications are that if you buy this option, okay, the single one, the cost of the trade would be $57. Okay, this is how much you will need in your account to be. You will need to have in your account to buy the trade, to buy this option. Okay, 57. I mean, and nothing new. You can see it here. So if I look at the 32, okay, anywhere between 57 to 60, that's what you need to pay, is right there. Okay, but it's more convenient for me to see it here with the decimal places and everything. So 57.65, that's what you will need to do this trade if you buy the single 32 call. But what if you do the vertical spread? Well, if you do the vertical spread, which we said is equivalent, again, there is a lot of many things to discuss here to talk about equivalency. So it's not exactly equivalent at all, but let's call it equivalent. But what happens? Well, that option would cost you 81. So what do you notice? That in this case, the one below cost you more than the one above. And they are equivalent based on my assumption here. So what would you do? Well, you would go for the one on the top. That's what you would do. So that particular day, you would pay $52 to be in the trade, okay, instead of 81. But there will be times as well, and this normally has to do with the price of the stock, especially when the price of the stock goes higher. Again, it's not always like that because options pricings are very dynamic, okay? But there are many times where when the price of the stock is higher, then the spread will make the trade to be cheaper. So in other words, when you say, what is the minimum? Well, another question or answer to add to this question is, are you going to trade simple strategies or complex? Okay, because if you're open to the spreads, then actually, even with a small account, you may be able to trade stocks of a much higher price point because now you do the spread, and with higher price point stocks, it will bring the cost of the trades down. Okay, so that's why earlier when I said when you use the scanner, okay, depending if you use spreads or you don't, when you came here and you change the operator to between, right? And earlier I show you between 15 and 50. Well, maybe with a $10,000 account, you can go easily to between 15 and 100, right? And you would be like, how can I trade $100 stocks? Well, because you do spreads, and that lowers the cost in many cases. Okay, so that's something else for you to keep into consideration. Okay, but there is something else I need to add to this one. Okay, so you can see why I took time today to talk about this, because it's such a rich question. Okay, so there is one more thing I need to discuss here, which is what is better for me, to use stops or to not to use stops at all. So take a look at this. Let's say you're gonna trade options on Home Depot. Home Depot is a $200 stock. Okay, so let's say you come here, HD, Home Depot. Okay, so Home Depot, and it's $11 now. Okay, so that's $1,000 over dollars. So let's do the same thing: analyze and buy a single, and analyze and buy a vertical spread. Okay, so let's say you are looking to do the trade with Home Depot, and I'm going to do the same thing. Try to adjust my deltas to be around 30. Let's see the 230. Yeah, the 230 is giving me 31. So let's compare that with let me see. Here we go. So if I do 225 to 65, okay, if I do this spread, I get 31 delta at the current price. Okay. If instead of doing the vertical spread, I uncheck and now I check the single, I also get 31 delta by doing the 200 call, the 230 call. Okay. So those trades are just following the same thing I did before, equivalent. Now, the trade with the 230 call would cost me $500. Okay. Where the spread, let's take a look at the spread. The spread in this case will be just a little higher price point. So again, as I said, it varies. There is a lot of implications. There are many implications here. The strikes are selected, many implications. But no matter what, let's say any of those two trades was good for you. So the question now is, what is better for me? To set a stop, okay, let's say 212. Okay, I'm just gonna run numbers to make it easy. Let's say 212 is my entry, and let's say 208 is my stop. If 212 is my entry and 208 is my stop, okay, and I use a single option. So what's going to happen is I will pay 500 over dollars to get into the trade, and if I get stopped out, I will need to exit the trade and get paid 424. So in other words, the difference between those two values, 536.99 minus 424.39, the difference between those two values would be the size of my loss. So I would lose $112 in this trade. In the other case, with the vertical spread, it would cost you 600, you would get paid 500. Sorry for that. I just hit the wrong key combination on my computer. Here we go. So if I was to do that, so instead of 112, how much would that be? So 623.95 minus 507.96. So it would be 115. It's about the same. We said is equivalent, isn't it? So it's about the same. Okay. So you would say, okay, so if I use stops and I get stopped out, I will lose, let's round it up, 120. If I don't use stops, okay, which if you're coming from the world of Forex and futures, you may be like, what? Jose just got crazy? I never heard Jose say, don't use stops, because I would never trade without stops with Forex and futures. But with options, what happens if you buy an option or you buy a spread? Well, if you buy a spread and you pay 623.94, so what's the most you can lose? Well, worst case is that the stock went all the way against you, never came back. The options expired on June 19. So how much you lost? Well, you just lost 620 over dollars, which is what you pay for the option. But if there is no way you can lose more than that, even though the value of the stock is more, the most you can lose is what you pay for the options contract. So not using stops in options doesn't mean we are crazy. We have, for sure, it depends on the option strategy. If you sell a call naked, that's a different story. That's unlimited risk, okay? But if you buy an option, if you do what is known as a debit strategy, the more you can lose is the debit paid. And therefore, even if you decided not to use stops, the amount of money you will lose is limited by the amount of premium paid, which is in this case 600 something. So my question to you is, what is best? To go for a stop, and if you're wrong, lose 120, or don't use stops, okay? And if you're wrong, what the most you will lose is 623. Well, some of you may say, wait a minute, 120 is way better, so let's use stops. But I need to open your eyes to a couple of important things that, in my mind, makes it more interesting to actually think of this as your risk instead of think of this as your risk. Okay, and in other words, if your account is 10,000 and you want to risk 1% per trade, then you will not be able to take this trade. Okay? You could almost take this trade using stops, but you cannot take the trade without using stops because 600 is way over 1% risk. That would also be a limiting factor for your trading if you decide to not use stops. Okay. So why am I talking about this? Well, very simple. Take a look at the difference between the bid and the ask price for that particular trade. The bid price is 594. The ask price is 665. And sure, the market is closed, so the spreads widen. Okay. But pretending the market is open, the difference between 665 and 594. Let me do that again. The difference between 665 and 594, that is 0.71. In the world of options, everything is times 100, so that's $71. In other words, if you get stopped out, it's going to be a stop market order. You're going to get slippage. You're going to get the whole spread against you. So we just calculated you're going to lose 120, but guess what? You're going to have a surprise of additional $71 of loss. This, my friends, is options trading. Slippage in options trading, it's massive when using stops. And by the way, Murphy's Law apply. If you get stopped out right at the open, you will, on top of that, be hurt by the lack of liquidity at the open, which is way worse than what we see on the screen now. And you may end up doubling your risk. You thought you would lose 120 maximum. You ended up doubling the size of the loss. So in other words, if you want to account for that, you need to go with half of the size. isn't it? And or another way to say half of the size means that you are willing to take double the risk, which is 120 is 240, right? So, I mean, if you think about it, now you are getting closer and closer to $600. I mean, 600 is still far away, but what's the second benefit of not using stops? Because the first problem is the fact that you will get humongous slippage many times in options trading. Anyone has been there before? You guys feel free to comment. Anyone has ever been there before with humongous slippage on options trading being stopped out? Okay, because in the entry you use a limit order, you manage it, but in the exit it's going to be a stop market, isn't it? So what's the second reason? Well, the second reason is because let's say you are looking at Home Depot, this is your entry right there, and you decide to have your stop below the second UFO. So price comes to you, stops you out, keeps going, gets into the next UFO, and then gets all the way to your target, but guess what? You're out. So has this ever happened to you? Of course, this happens to everybody. But the real question, and please feel free to comment on the chat box, the real question is, which market is the market where this happens the most often? The futures, the Forex, or the stocks? And it's the stocks. And why am I so positive about it? Well, look at that figure. 43% when you apply AutoUFOs for stocks versus if I use the euro, it's 58% versus if I use the S&P futures, is 60%. So why is this happening? Well, it's very simple. The S&P futures or the euro are markets by themselves. They are the thing. The euro is the euro. The S&P is the S&P. But a stock, I mean, if you think of the S&P, I mean, let's go ahead and run a scan, okay? And out of curiosity, let me do it here. So you get to see those figures. So maximize. So I'm gonna run the scan, run, and here it says applying symbol. This is what I want you to observe. Symbol 8,817. So let's call it 9,000 stocks in the US market. So stocks are stocks. In other words, even if you pick a big stock, it's still one out of 9,000. So you heard me say a million times stocks are fragile. And they are. Indeed they are. Orders are canceled more easily, right? Everything is more fragile in the stock market. So coming back to Home Depot, this situation. Sorry, guys. Let me type it correctly. So this situation where you have multiple UFOs, you place the stop somewhere here or whatever, or even here. And then you know what? A very strong market correction happens, goes to the next one, and then comes back up. Okay, and this may take way more than expected. It may take 2 months. But guess what? You got options that expire in June 19. So now you're giving yourself time for this to come back, right? We had many trades like that in the sessions where the UFOs we were relying on didn't do what we were expecting to do because the stock market is only open 6.5 hours a day and then it closes and then many orders get canceled and it's fragile, right? And but then there were other UFOs that did work and brought the price back up. And of course, when we have crazy moves like the ones that we just saw in the prior month and beginning of April, so certainly that's it. Forget about it. All the orders are going to be canceled. Many orders, many opposite orders are going to be added, and the market will never come back. And your option will expire, and you will lose the whole amount of premium paid. Okay, but this will happen less often compared to if you use a stop. So the two benefits of not using stops is avoiding the slippage and getting many trades that initially went against you go back to live, and therefore increase your win-loss ratio more than what you would do when using stops, which is important to me because stocks are fragile, and therefore it's especially useful in that scenario. Okay. The downside, of course, is that now instead of if you were counting on if you were counting on this trade with $240 of risk, right? Because I said 120 and you count on double the risk, so that's 240. So if you were counting on taking this trade with $240 of risk, so then you would go for it, and maybe you would buy multiple contracts. But now, if this trade is going to have a risk of $650 instead, well, that now you may not be able to take this trade, or it's going to be one contract only instead of multiple contracts. Okay, so in other words, not using stops would limit the price of the stocks you use. So again, going back to what I said before, you will need to work on your scanner to customize the between, okay, and set a ceiling for yourself when it comes to the highest price for the stocks. So that way, you don't find yourself planning trades, preparing the trades just to conclude, the options are too expensive, I cannot take it. Right? So limit the price of the stock to avoid this problem. Guys, good news. The remaining part of this slide should be, the remaining part of the questions should be answered quite quickly. There is very little left for me to answer now, okay? Even though I'm still on the top, okay? Let me take a look at your questions here. And Marcus, especially for you, how is it going so far? Because again, it's a pretty dense answer here. Paul, if you have a limited account, would you suggest FX is better than options for the other way around? Well, the issue with FX, okay, and FX is great, but the issue is that most of the currencies have certain degree of correlation or inverse correlation. So what's the problem? The problem is that unless you trade very short-term intraday, which is not ideal with spot forex because it's a decentralized market, correct? So unless you trade very short-term intraday, the problem with spot forex is that you cannot take too many trades in parallel because many of those currencies are going to be correlated. Unless you're using very long time frames, you are doing carry trades, so you are doing very fancy things, it's difficult to run a portfolio with multiple currencies in parallel. So to me, it's either you are combining forex and futures and you have a little bit of a combination of both, or then you have to be very patient and not be too demanding with the results that you obtain from forex, because running multiple trades in parallel would certainly increase your risks very much. Let's say you are long the euro, long the pound, long the Aussie. It's either you get 3 winners in a row or 3 losses in a row because you are against the US dollar in those 3 trades. It's highly correlated, right? With stocks, it's also highly correlated because it's all about the S&P. But at the same time, you got 9,000. So you will always find stocks in an uptrend, stocks in a downtrend, etc., etc., and you can always put together a portfolio of multiple stocks that offset each other, and that could be quite powerful too. Okay, so in a perfect world, you guys trade. In a perfect world, you guys trade a mix of assets. This is probably the best way to trade, even though of course it takes more time to learn and more time to practice. Okay, but that's my way to think about it. Okay, I don't see a way around. I just think a way to combine the benefits of those assets, okay, without falling into the problems that all assets have, because everything in life got pros and cons, okay, and that's what basically I'm touching on. Osman, how far should you consider UFOs is not inside the EMA? Well, it's either inside or it's not. It's black or white. So there is no breathing space. It's inside or it's not inside. And if you're not sure, set an alert so when it comes close, you can confirm. Sandeep, do you always use TradeStation for options trading? Sometimes I feel it's difficult to close as pairs of an iron condor in TradeStation. Well, to be honest, I use multiple platforms. Thinkorswim, Interactive Brokers, and TradeStation are the 3 platforms I use for options trading. I also use other platforms in the past, MB Trading, Ali, all sorts of things. But those 3 are the 3 I prefer. And I have to say that Interactive Brokers is by far the most complicated platform to utilize, but it has amazing features if you manage multiple accounts at the same time. For example, accounts from family members and things like that. So that's very, very, very powerful. Thinkorswim for execution for options is by far the easiest to use. And TradeStation is halfway in between from a simplicity of usage. Now, having said that, when it comes to the quality of the routing and getting the best price, I always found TradeStation to give me the best prices, even when I use market orders. I always found Thinkorswim to be the second one giving the best prices after TrustStation. And it's funny because Thinkorswim has the reputation to be the best, but to be honest, TrustStation gives better pricings. At least is my experience. And then Interactive Brokers always gives me the worst, even though when you trade multiple accounts, it's so convenient. And really the features to link accounts, to have master accounts and slave accounts, there is nothing like Interactive Brokers in my case. So, to me, it's worth it to pay 1 cent extra when you get into an options trade. It's fine. That's my experience, by the way. Okay. And again, you guys may have different experience. Maria, would it be possible to have a session about options backtesting? I feel it's difficult short term, Maria, but certainly I will make a note of your request, because certainly it would be a great follow up of the class during the last week, isn't it? So I get you. At the same time, we have many things in our hands at the moment, and again, short term I see it difficult. Okay, but certainly my wish is there, and my willingness to do it as well, and we'll try to find a way. Okay, Marcus, very good, Jose. Many thanks. That were necessary inputs I was looking for to make a decision whether or not to get into options. Look, I mean, you will love it, Marcus. You will love it. Options are really beautiful. I always say options give you options. So it's true. Anyway, so in FX, the dollar risk is adjustable, and in future is about $80 per contract. That's your experience, okay? So again, that experience is what you need to develop with options to know which figures to use in the scanner when you type the between figures, okay, right? So in Forex and futures, I need to be ready to get a full stop about 60% of the times. So now you know better what to expect with options trading. And when you join me in the sessions, you will see me not to use stops. And now you know why. Okay. So you will be able to see that in your account as well. And by the way, we just concluded a backtesting class, isn't it? So this could be a tracking variable. Okay. Going back to Becky's content. So what if I use stops? What if I didn't use stops? You can certainly have a tracking variable there. What option strategy would make most sense to learn first? One that is simple and doable. Basically, you are concluding it from my presentation today, isn't it? So long calls, long puts, and spreads. And now long calls and long puts got a huge, massive exposure to volatility in options. And what I mean by volatility is not what Forex and futures traders understand by volatility. I mean volatility from an options terminology standpoint, which has a direct impact with the price of the option. Okay, when you buy an option, buy a call, buy a put, you are very heavily exposed to changes in the price of the option. So it's not ideal unless you know very well what you're doing with options pricing. So probably the best option strategy for you to use, okay, that would limit you for one trade a day. I believe probably that's enough. So if that's the case, then option spreads, bull call spreads, bear put spreads, those would be the way to do it. Another way to call them, it's debit spreads or debit vertical spreads. That would be the way you can find literature on the internet as well. And that would be probably the best strategy for you or anyone in general when having limited account size, okay? And then if you want to experience with iron condors and stuff like that, well, you could do what I used to do, but I would go ahead and say, don't make your life complicated. Just practice iron condors in a demo account, gain experience with it, build up your account with either saving a little money and making some profits with your options trades. And when you get to 25K or above, then you'll be able to do non-directional trading as well. And that would be the way to do it, okay? Good. So, my friends, can you believe it? An hour and a half to answer one question. That is how important and relevant that question was. Okay, Marcus, thank you very much. I think that this question is extremely powerful, not only for yourself but also for many other traders, students of trading that are joining us today live or joining our YouTube channel, watching this recorded. What a great way to think about what do I need to trade options? Is options for me, yes or no? It was a very important conversation for us to have. So thanks for the question, and hopefully it did help. My friends, we just reached the ending time of the session, and I don't see any other questions popping up. So I will just say thank you very much for joining me. Hopefully today's conversation was very useful for everybody. And keep up the good work, guys. Again, I receive emails from time to time from you guys. Sometimes they are simple emails and my team deals with them. Sometimes they are more complex and I get to see your emails and stuff. And I'm delighted to see how advanced some of you are getting and your progresses. So keep up the good work. It's amazing. If you are in earlier stages and you need support, of course, join us here in the YouTube channel, in everything we do, guys. As you saw on the calendar, we are running other courses as well and everything else. So just use the tools, join us, and be interactive. Ask questions, send questions on the emails, and certainly be ready to participate. The ideal place where to ask questions really is here, because you can see that the depth of answers we can get into is way beyond what I could do or what my team could do by responding an email with a couple of paragraphs. Okay, so keep up the good work, be engaged. We're here to help you. See you soon, my friends. And also, getting a bit serious here now. Be safe, everybody. The world is quite crazy out there. Many places in the world are now removing limitations and confinement and all of this. But it doesn't matter. It doesn't mean that we need to be over relaxed about the problem happening in the world. Okay, so everybody, be safe, be healthy, stay healthy, take care of yourself, take care of the people around you, and see you in the next one. Bye bye, everybody.